You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. Welcome to the show, Keith.
Jim, good to see you again.
Everybody likes to rub the crystal ball and forecast oil prices. Are we just getting a bunch of hooey? Is it like going to the psychic at the PNE?
That's not a bad analogy. I think that the people who do the prognosticating would be a little offended by that. But the reality is there's so many different players out there with so many different ideas on where oil prices are going. You're not that far off. I think the one thing to talk about that investors really need to take into account, Jim, is the U.S. government agency that does most of the official forecasting. It's called the Energy Information Administration, or the EIA. And so it's quite confusing for investors because there's another group out of Paris, France, called the International Energy Agency, the IEA. So we have to keep all our letters in a row. But the U.S. government agency, they're called the EIA, and they really are probably the best official agency in the world at kind of forecasting where things are going. But even they admit very candidly and very openly that they're guessing. And it seems kind of interesting because each week they put out reports on what oil production and inventory levels are on Wednesday mornings, and on Thursday mornings they do natural gas. Every month they come out with a drilling productivity report. They also come out with a short-term energy observation, the STEO. So there's many different reports, and it's just stunning to see investors plow literally each week billions and billions of dollars into energy ETFs, stocks, all based on these admittedly pretty loose guesses by the EIA, and investors have been holding them up on a pedestal saying, oh yeah, but they say this, and it's like, guys, honestly, please, do yourselves a favor and do not go out and invest. And the EIA actually, their staffers are publicly on the record as saying, do not go out and invest your money based on these guesses that we're doing. But that doesn't seem to be taking hold. So basically what the EIA does in any given report is kind of look at what's the trends that have been happening in terms of production and number of wells. So they're a great data gatherer, but then when they go out and make guesses about extrapolating those trends, they're doing the same thing that private industry does with that data. And there's a lot of people, and I'm one of them, who would suggest, you know what, if these people were really talented in a amazing way, that private industry would hire them away. So I'm just not convinced that the EIA really has the best guesses that investors should be taking all their data from.
In other words, these guys couldn't find jobs in the industry, so now they advise industry.
Well, no, I wouldn't go quite that far. But the reality is that I would suggest it's pretty common sense if there was any particular very bright light there, they would get sucked up by private industry. No, I've talked to some of these people, Jim, and they have good hearts. They do the best research they can. They're very honest in their work, and they're very candid that they are just using a certain methodology that guesses, that forecasts, that extrapolates. So, and there's revisions every month to all this data, and the revisions are often looked at as just as important as the guesses when they first come out. So it's something here that I think investors really need to take with a big grain of salt, the weekly and the monthly numbers that come out of the EIA that get trumped up by many different websites and news organizations as the be-all and end-all, when that's just not the case.
Are there private organizations that do the same thing?
Oh, yeah, a dozen for sure. PIRA, CIRA, CIRI in Canada, Bentech in the States, Platts, Opus, like the list just goes on and on and on. And these guys get paid pretty big bucks to do things like monitor pipeline flows and run very sophisticated models on production and demand. So yeah, absolutely. And of course all the brokerage firms kind of do this on their own as well.
And is their advice any better than what comes out of the government agency?
I would say that the short answer is that depends, and I guess the real answer is, Jim, that everybody does something a little bit different. So, for example, Bentech and Opus, they monitor pipeline flows, and that's actually quite easy to do. So that's very accurate, up-to-date information. So that's much easier to extrapolate data from than opposed to just taking, monthly production numbers and extrapolating them out. But Bentech and Genscape are kind of considered the two groups on the natural gas side who seem to monitor pipeline flows. And I guess really Opus is a big up-and-comer on that too, where those three companies are looked on as the gurus of the industry. And if your data is contradicting them, you really kind of have to look at what's happening. So, and on the oil side, I would say there's just absolutely nobody. Nobody stands head and shoulders above anybody else. People look at it from different points of view. You look at Stephen Shork in the Shork Report, or Dennis Gartman. They look at how the term structure of oil prices in each of the next few months and years looks, and they interpret different data points on that. But no, I would say there's nobody out there that the market looks to as an almighty first point of reference for what oil prices are going to do.
And I guess when prices were going up, it was pretty easy to be accurate. We can say prices are going up, but once they started to fall, people want to know how fast, how long, and how bad. That's the hard thing to predict, isn't it?
You're bang on, Jim. And really what we're talking about more than up and down is just volatility. The speed of volatility has just increased so much, where you saw, once the Saudis said, no, we're not going to support the oil market, you saw a rapid collapse in prices, and then you saw a rapid collapse in rig count, and the street expected a rapid decline in U.S. production, and they got the first two, but not the third. So when you've got this fast-moving fundamentals, it's difficult for anybody to have a real clue about what's going on, and so that's what I've been telling my subscribers is like, look, this is not a year for big bets for large purchases in the energy sector, because fundamentals are changing so quickly. We just don't know how it's going to shake out. Demand came in way higher than everybody expected. Like really from January of 2015 on, that the numbers were just staggering. Everyone thought that oil demand was fairly inelastic, meaning that if price went down, it didn't actually increase demand. Well, that was shown to be a load of a hooey very quickly. Demand started off at about 300,000 gallons a day more, or barrels a day more, forgive me, and now it's been as high as 1 million barrels a day more demand as gas prices have continued to fall in the United States.
Well, perhaps they're finding out if you lower the price of something, people will use it more often.
Well, yeah, and you and I know that's to be simple economics, grade 12 economics, but the reality is that there was a lot of people in the world who had stats behind them that said, actually, oil demand doesn't increase that much over time, but it certainly does.
Well, when we had the first big price fall, I remember an interview with a service station owner who said he'd never done better in the last 5 years because everybody was filling their tanks to full rather than just what they needed. And what's more, they cut down on the number of trips per week.
Yep.
So if you could fill up your tank for half the price, all of a sudden visiting the cousin or the uncle or the aunt 200 miles away became affordable again.
Mm-hmm. Absolutely. You're bang on. And so it's really just a question of, and here in Canada, we haven't had it near as good as the States simply because our dollar has fallen so much, right? So that's kind of cushioned the downfall of oil prices. So because our dollar has fallen along with it, that's great for the producers, but not so good for the consumers.
We'll have more with Keith Schaefer right after this.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon and Garfunkel in Oliver, October 2nd, in Kelowna, October 3rd. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. Keith, you're advising people who are looking to invest in oil, don't panic when you see the price fall down as we get out of the driving season, simply because it is fall, and that's when oil prices traditionally go down.
Sure, there's a seasonality, Jim, to the whole energy market, and obviously summer driving season is peak demand, and then winter heating season is also peak demand, and in between, what happens is all the refineries in the northern hemisphere in the fall, they kind of have their maintenance periods, so they have to shut down for anywhere from usually 1 to 2 weeks to make sure everything's working properly, clean the plant, do any repairs. And what's happened here recently, because refinery runs have been so high, like the U.S. has been running at record capacity for the last 4 months, about 96% capacity I think we peaked out at, when normally it would only be like a 92, 93% peak with an average of 86 to 89% throughput. It's been quite a bit higher than that. So we're going to see more. So aside from consumers driving less as we get into September, October, and November, you're also going to see, less gasoline being made by the refineries, and because production is not slowing down really that much at all, you're going to see a backup in oil inventories. That they're going to go higher, and so prices are going to go lower realistically through mid to late November, I think. So, today we're sitting here with, I got the crude quote right in front of me, WTI is $45 and Brent's 48.5. So, we're probably going to be pretty range bound and probably have a little bit of downside over the next 2 months until winter heating season starts up and all the refineries change from making summer gasoline to winter gasoline and more heating fuel. So, this is just a very normal time, and I would say that that the shoulder season can actually be often a great time to buy energy stocks. I'm not sure that's the case this year, just because there's so much production happening in the world. We've seen Iraq pick up almost 1 million barrels a day. Iran's promising to add another 1 million barrels a day. The North Sea hit a 3-year high in production last month. Nigeria hit a 3-year high in production last month. Canada has about 500,000 barrels a day of new heavy oil production coming on stream over the next 2 years that really the market does not need. So we're going to need to continue to see some fairly large demand increases to see oil prices break out.
What about people in the oil business itself? I know many were optimistic still that this is going to be a short downturn and that they'll be back on the rigs, within a few months. Is that a false hope?
No, I think that it's definitely a false hope for the next little while. The cure for low prices is low prices, but it's when you've got such a determined group on one end of the spectrum at OPEC, determined to basically steal back market share that they've lost to the shale producers. It could take a while. I think any hope of unless there is some kind of demand response that is well above and beyond anything we've seen in the past, it's going to take a while.
Keith, anything else you wanted to throw in right now?
Jim, I just think that, like I say, now is the time to be very cautious in the energy markets. I've been telling people that refineries are really the better choice to be as opposed to the producers. But even those stocks are going to go up and down with the Dow. And September and October are generally very choppy periods for the Dow and the big boards. So there's nothing wrong with being patient. It's hard for retail investors to be patient and sometimes do nothing, but oftentimes that's the best thing to do. In the next 2 months, that could be the case.
Keith, thanks a lot for chatting with us.
Jim, God bless. Chat in a couple weeks.
My guest has been Keith Schaefer, editor and publisher of Oil and Gas Investments Bulletin, the website oilandgas-investments.com. You're listening to HowStreet.com radio. Follow us on Twitter at Talk Digital Net. Check out our YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.